going to do the cash flow statement here. So to do the cash flow statement, you need to basically bring in certain things. So let's go to the desktop, and I need to have this one. Let me copy that. I'll put it over here. I will paste it. How to paste this? Okay. I have this one here. Okay. This is the balance sheet that I have. Fair enough. I also need to have an income statement, right? So I'll come here and I'll do what? Paste it. Okay, let me make it a bit bigger. So I have the income statement. Oh, these both are balance sheet. So let me go to the income statement and see if I'm basically copying that. Okay. Why is it income statement again? Let me see. Let me copy this. Come here. Why am I not able to paste it? Honey. ഓ എന്നെ ഒന്നുമില്ല ഒന്നുമില്ല ഒരു സാധനമില്ല ഒരു സാധനം ഇല്ലെന്ന് So we have to do the income, the cash flow, the cash flow indirect method. Okay, so we have all the ingredients to make the cash flow indirect method. What do we need? We need to have an income statement. We have to have a comparative balance sheet. Okay, that's what we need to have. Okay, so we have that. All right, so now we have 3 sessions. So we start off our indirect method cash flow with the net income. So where do we get the net income from? You get the net income from 32,000 is here. Okay, now we know this net income is based on accrual income. So we have to do certain adjustments to the accrual income. Okay, so let's say we have depreciation. Depreciation is a non-cash expense which might have reduced the net income. For example, in accrual basis, uh, uh, you know, income statement, we might have booked this entry, right? Depreciation 60,000 to accumulated depreciation. Okay, since this is an expense account, right? This might have reduced net income. Okay, so this is, but then really no cash has gone out, right? No cash has really gone out. So therefore, we have to add it back. So we have to add depreciation. This is a non-cash expense that has reduced the net income, so we'll add it back. Okay, that's what we do. So I don't see any other non-cash expense or non-cash income in the income statement, so that's fair enough. So now we're going to do the reconciliation between the balance sheet comparative figures. So this is where we have to reach. This is the figure that we have to reach. Okay, and this is where we are now, 32. So how do we reach from 32 to 530? That's a question, right? That's a question. So we'll see whether these things, current assets, have increased or not. So how do we see that? How do we see that? Let's see. This is 2021. This is 2022. Fair enough. Okay, this is 2022. Okay, so accounts receivable was 50,000, but now it is 20,000. That means accounts receivable decreased by 30,000. Okay, that's good sign. Why is it good sign? Because for cash flow point of view, collecting cash from the accounts receivable is an inflow of cash. So therefore, we would add decrease in cash, decrease in AR. So if AR has decreased, we will add it back. If AR had increased, we would have deducted it. Okay, so we would add it back. All right. Then we will go to the inventory. Inventory has increased 10,000. Increase inventory has increased by 40,000. Okay, inventory is a current asset. It has increased, so we'll have to less it. Okay, for cash flow statement, our cash is blocked. Okay, so therefore add increase in inventory. Okay, 40,000. We would have to make it less. So two things are done. Plant and machinery, this is actually an investing item, so we'll not take it in operating. Accumulated depreciation, it was 25, it has become 85, and that's the reason this depreciation 60. This is a 60,000. We have already considered that. So that part is over. So now we would look around at current liabilities. Okay, the rule is whenever current liabilities are increasing, that's good. That's good for cash flows point of view. So 10,000 accounts payable has increased. So there is a 20,000 increase. We would add it. Okay, add increase in current, accounts payable. Okay, this is, so how much is the increase? We will add this one, 20,000. Pretty good, right? Wages payable, another 20,000. That's again okay, an increase in wages. Okay, another 20,000. We would increase it. All right. Interest payable has reduced. That means we paid. So interest payable is a current liability, so that has decreased. So less interest payable. Okay, interest payable, it's a current liability, it has decreased, so we'll decrease it. It's a direct relationship. 2,000 decrease. All right, so that is done. Income taxes payable was 1,000, but we paid. Okay, less income taxes payable. Okay, that's not seen. Okay, so that's again another decrease. Okay, um, there is something called unearned revenue. Okay, unearned revenue was zero. Okay, uh, unearned revenue was zero in 2021, but we have an unearned revenue of 22. Okay, so that's a current liability. Okay, increasing. So we will add that. Add unearned revenue 110,000. Okay, that's 110,000. Pretty good. We've done with that. Notes payable, no change. Common stock, of course, it doesn't come in the operating section of the cash flow. Retained earnings, of course, it doesn't come in operating cash flow, right? So therefore, we don't do that. Let's see what is the net change from operating. Okay, let's add up everything. If you add up everything, 32,000, that was your net income. Plus you're adding back the depreciation, 60,000. Plus you're adding back decrease in receivables, 30,000. Minus inventory increase, minus 40,000. Then accounts payable increase by 20,000. You will increase it back. Wages, another increase, 20,000. Okay, and there is a 2,000 decrease. Okay, fine. And there is a 1,000 decrease. Fine. And there is an increase of 110,000. So cash flow from operating activities. Cash flow from operating activities has been 229,000. Fair enough. Okay, that has been 229,000. So we have to have the cash flow from investing. Okay, next, cash flow from investing we have to do. So for cash flow from investing, where you have to check this portion. Okay, this is an investing. So basically, you had the property, plant and equipment (PPE) sitting at 200,000. Okay, so it was 200,000, right? It was 200,000. Okay, on that you had 60,000. So it should have been book value 140. But when you see, okay, the actual change is how much? 500,000 minus 140. That means you bought this much, 360,000. Uh, okay, the cash flow has been decreased, 360,000. Okay, cash flow has decreased by 360,000. Okay, because you assume that you paid for this, right? 360 is the decrease from investing activities. So now let's see if anything else is there. Unearned revenue, notes payable. Okay, uh, I don't see anything, so let's go further. Let's go further and see the rest of it. So this is a minus, this is a plus. Fine. We'll see cash flow from financing. This is the third section that we are going to see. This is the first one, this is the second one, this is the third one. Okay, cash flow from financing. So for cash flow from financing, if you want to see notes payable, it didn't change. Okay, common stock has increased, so more issuance of common stock. 100,000 is increased by common stock has increased by 100,000, right? 100,000 is increased, so that's an increase. Cash flow from financing. And retained earnings, it was 12,000. Okay, so let's see if any dividends were paid. Okay, so how do we see this? The retained earnings beginning of the year was 12,000. Then we earned a 32,000 profits, right? So that might have gone to the retained earnings. So it's 44,000. So basically 12,000 plus 32 is 44. That means there is no change in retained earnings, right? There is no change in retained earnings, which means that we do not pay out any dividends. Okay, that's what it shows, right? So we're done with that. So let's add up everything and we'll call it net cash inflow or outflow. Okay, we'll see this net cash inflow or outflow. So let's add up everything. So we have a minus. So let's add up 229,000 plus 100,000. So that's a 329,000 minus 360,000. So that's a minus 31,000, right? Minus 31,000. It's a minus 31,000. Okay. This is the third section. So now we will bring in this cash at the beginning. Okay. Cash at beginning. How much was the cash at the beginning? 501,000, right? So we brought in cash at the beginning. So the cash at the end should be how much? $501 minus, okay, there is some mistake that we've done. Let me see. Okay, 501,000, that was the beginning cash, minus the negative cash that we brought in, 31,000. So it should have been 470, right? Should have been 470,000. Okay, but how much are we seeing in the cash? We're seeing this 30. All right, let's see. 530,000 minus 470,000. So that's a 60,000. Okay, that's 60,000 is there. So this 60,000 is the problem there. All right, this 60,000 shouldn't be there. It should be 300,000. The change should be taken because we already taken this one there. So let's see how much is that then. Okay, based on that. So we understood there is a mistake. So it's going to be 300,000. Oh, that's a minus, right? So let's see, 329,000. Okay, that's nothing but this 229 from cash flow from operating and financing. That's a 329 minus 300,000. That's a minus, right? So we have a net change of positive 29. Okay, so it's a positive 29. Okay, it's a positive 29. This is wrong. So 501 plus 29,000. Now we need to add up. Okay, 29,000 is the net cash change plus 501 is the cash at the beginning. Should be 530,000. This should be the cash. So this is correct. Now you can see this is the cash. So basically this is a reconciliation. This is also called a reconciliation method. Okay, indirect method is also called a reconciliation method. we basically started off with the net income figure 32,000 and we reached the cash of the balance sheet, and that's the reason it's called a reconciliation method. Okay, this is the reason it's called a reconciliation method, because basically we are actually reconciling from the net income figure to the cash, right? So if you are a cash basis, entity, of course, this 32,000 should have been the cash at the bank also. Why would you do this? Because you're doing accrual basis accounting. And now in this question, we do not have any, additional adjustments or something like that. So therefore, this was pretty simple. Yeah. So sometimes there'll be more adjustments like depreciation, right? Many non-cash expenses, many non-cash incomes which you need to adjust on. Okay, those kind of adjustments also could be there. So the operating section is the key, right? Operating section is the key. Now there is also called an direct method, which is the investing section and the financing section. This is going to be the same for both the methods, direct or indirect. The only difference is in the operating section, wherein you don't calculate direct method from the net income. You will directly, you will see what is the cash collected from customers, what is the cash paid for suppliers, what is the cash paid to employees, what is the cash paid for other expenses, and that's how you reach the operating activities cash. But the figure will be the same. Okay, you will reach the same figures. The only method is the change between direct and indirect. So the reason is, now let's say now IFRS and GAAP, they both like direct method, but then if you do direct method, you also have to do indirect method as a reconciliation. And since direct method is not mandatory, that's the reason many of the entities are actually going and preparing indirect method, so they can escape basically preparing direct method, right? Now ideally, one thing that you need to see here is how do you analyze this? These things are very, very important. These things are very important. Okay, why is it important? Because now look at this. Now this cash from operating activities, you need to have a positive figure. Why? Because if you see a negative figure here, that means the company is not generating enough funds for its operations, from its operation to sustain. So if you see a negative cash flow from operating activities, the company, the entity is having an issue with liquidity. Okay, and ideally, for investing section, you would love to see a negative figure. Okay, you would want to see a negative figure. Why? Because you want to see the company growing, right? When you grow, you invest money in property, plant, and equipment. So ideally, you should see a negative figure. If you see a positive figure, that means you're selling of your assets, right? Selling of your tangible assets, right? Financing section could be a positive or negative, okay, depending on the cost of capital and things like that, on the scenarios. So this one you want to ideally see a positive one. This one ideally you want to see a negative one. This could be either a positive or a negative one. Okay, that's about cash flows, guys. See you later with